how can we interpret the Fed cutting the Fed funds rates? And I want to cover different aspects around inflation, which we're going to get into some of the stuff around bonds, around the 10-year treasury. I want to get into some of the stuff around the job market. Then I want to get into 3 specific areas that could have a positive impact on you if you're playing this as well as we possibly can. Now, when we're thinking through this lens, okay, when we're looking at the Fed cutting rates, there's a couple key factors here. And if we can understand the bond market, that's going to help quite a bit. So if we think about the bond market, when the government is in debt, right, when we have a continuous deficit year over year over year, when this deficit is constantly growing, the way that this then leads to higher debt is that, or the way that we pay off that debt is that the government's going to ask for an IOU essentially. So there's different IOUs where there's going to be a note. It's in the same sense of I'm asking my grandfather, let's say this 10 years ago, Granddad, can you give me $1,000? He would say, okay, here's $1,000. But every single month or every single quarter, you have to pay 4% on that $1,000. And then at the end of, let's say, 10 years or at the end of 2 years, whatever that time frame would be, you have to pay me that $1,000 back. But every single period, there's going to be that interest. Okay, so that's how the U.S. pays back the debt. Now, when the debt is rising, okay, there can be a massive potential devaluation of the view of how the U.S. is functioning. And when we think through this, okay, especially if it gets out of control. Now, when we're thinking through the Fed is essentially responsible for 2 things: inflation, okay, and the Fed is also responsible for the job market. So again, we're going to get into inflation, we're going to get into the job market, we're going to get into those 3 areas that you guys can sort of focus on, that I'm going to be focusing on coming off of this Fed cut. Hopefully you can like, subscribe, share this all over the place. Now, when we look at inflation, okay, printing more money, and if we're looking at right now, the first big factor here is that the Fed has a goal to keep inflation around 2%. If we look at today's notes from from Powell, from Chairman Powell, which I think is just a weird, I always think about, I don't know, I always just think through like he's the head of China. But anyway, when we look at Chair Powell and what he essentially is doing, right, he's looking at inflation, and inflation is not going down. It's not going down to 2%. And the plan is essentially in 2 years, it would work down to 2%. Now, the signal here that's interesting is that in the SEP, which is his report, or they have, I think it's 19 people that put together a report, and they essentially say, look, over the next time frame, this is how we think we can lower inflation. This is how we think we can have a positive impact on jobs. And that's essentially all they're focused on, right? Now, when they're looking at this, inflation's not going down. So the initial thing that we have to think through is that they're making this cut today because they want to have a positive impact on the job market. Now, the Bureau of Labor and Statistics just released that they just reevaluated, I think it was like the last 4 to 6 months, and we have lost over 1 million jobs more than they had actually recognized. Now, this is the largest loss of jobs since 2008, which is catastrophic. It's pretty freaking crazy, even to the point where the CEO of LinkedIn is even coming out and saying on recent podcasts, like, yo, this is getting pretty out of control. Like, the job market's pretty shitty right now. So they're cutting rates because they want to have a positive impact on the job market. So when we think through this, they're already planning. We're starting a cutting season. They're going to cut now. They're going to cut again in October. They're going to cut again in December, and they're likely going to cut 1 or 2 more times in 25 or 26. Now think through this lens, okay? Powell is done in May. And Trump is going to appoint somebody who's going to be even more hawkish on these cuts. So if we get back to the inflation discussion and where this is all going in regards to borrowing, is that inflation is not improving, and the Fed cutting, okay, has an impact, or it has a major correlation directly with the short-term treasury yields. But what impacts borrowing for mortgages and things like that, rates like that, is the 10-year treasury. And that is based off of the market, Okay, that is not based off of, a lot of people think like when the Fed cuts rates, the Fed's going to cut rates, and as soon as they cut rates, mortgage rates are going to drop. That's not going to happen. Okay, and the reason why that's not going to happen is that there's a lot of people hesitant to invest in these bonds, in these treasuries, because of inflation. And so what could possibly happen is that we might see, because less people are investing in that, to make it more attractive, they actually increase, the market will then increase the rates of return on these bonds of the 10-year treasury, which could have a negative impact on the mortgage rates. Okay, so we have to recognize that the fact that they're not cutting due to impacting inflation, they're actually cutting due to the job market. That is the problem here, and that's going to have a negative impact on the mortgage rates long term. And we can even see this now in the sense that, you know, in the mortgage rates are like 6.5%, 6.8%, something around those lines. And if we're looking at, you know, 3-4 years ago, if you bought a house, your mortgage rate's probably 3%. So that doesn't mean there's going to be a collapse either in the housing market. That just means that in the immediate future, there's going to be a softening of the housing market. Okay, that's going to happen. Now, inflation is going to keep rolling, and they're going to keep making these cuts, and that's going to continue, I believe, to increase inflation, which doesn't bode well for things like mortgage rates. The other aspect here that's a little interesting is that we've got to recognize the difference between the economy and the difference between the market. The market right now is made up, 40% of the S&P 500 is made up of 10 companies. Okay, so that can bode for a dangerous situation. This can be reminiscent of like the early 2000s, right? And so we've got to recognize, oh, and by the way, I did want to bring up even to the point where in the past when we have had cuts, Fed cuts, we've actually seen mortgage rates to a point rise slightly going back to the early 90s, and that has happened in the past historically. Now, as we move forward, okay, where we're seeing possibly that this is going to have a positive impact on the economy, and this is where I want you to think about the market is the stock market, and essentially it's, you know, 10 major companies and then probably about 90 more. Okay, and that's going to, we have to figure out that in the S&P 500, if the market is controlled by essentially, you know, the top 10 companies, we have to see, you know, does that put the market at risk? Is there a lot more potential for a downturn, a serious downturn long term? So those are some thoughts that we have to have moving forward strategically from a financial perspective. Now, off of that, we have to recognize the economy is not the market. Okay, the economy involves jobs, inflation, how the market is doing, all the interplay, how people are spending their money. And if we see interest rates going up on mortgages, they're either not going to be buying homes or they're going to be buying smaller houses. And people are going to tend to be a bit more frugal with their money and things along these lines, because it's starting to get really freaking expensive to live. So those are some really serious factors. Now, finally, what does this mean for the market and for investments? And this is where I think it's important for all of us to understand that when we're looking at this, okay, and we're thinking through, you know, and I even went back and I looked up some stuff. Sorry, I'm sitting here and I'm holding this in a selfie position. I don't know if you guys can see. I'm still just checking out all Tokyo. I was going to film this outside at nighttime, but it was still so super dark. I thought it would be cool to film a video at night in Tokyo, but I didn't get it done. Now, when we're looking at this moving forward, okay, over the since 1980, okay, when the Fed has cut rates and the S&P 500 is at an all-time high, what happens at the 6-month mark? The 6-month mark, it's like 50-50. When we are at all-time high. At the 6-month mark, the stock market could be up, stock market could be down. But we're thinking long-term play. What about the 12-month mark? In 1 year, after Fed fund rate cuts, when the S&P is at all-time highs since 1980, at the 12-month mark, we're higher. The market is higher. And this could be due to inflation, but this could also just be due to really strong companies. Okay, and so that bodes well. Now, where are we going to be looking at in the market? Obviously, those top 10 companies are powerful. You know, NVIDIA is huge, Microsoft's huge, all these companies are huge, right? I also think if you look at something like the Russell 2000, there's some companies in there that are going to be doing well because they're all US based. It's easier for these companies to borrow money. They're the companies that are also going to typically not be, they're going to be involved with AI, but not to the extent that the top 10 companies are. And I'm even thinking about companies that are going to be selling products that are affordable for everybody. Okay, so when I'm looking at this and I'm thinking through what can we do, what can I do on this, and I start to go back to what I've been thinking about recently is I'm looking at companies that I already own, e.l.f. Okay, so e.l.f. is selling beauty products that are dirt cheap. You can find them in your local grocery store for under 15 bucks. They're going to do really, really freaking well. Okay, I'm telling you, e.l.f. is going to do really well in my belief. This is not financial advice. Please don't take this as financial advice, but in my opinion, a company like e.l.f. is going to continue to grow really well. Another company that I think is going to do really well is Celsius. Celsius is an energy drink company. They're just starting to gain more control over Rockstar, which I think could make a big comeback. They just acquired Alani Nu. They're absolutely freaking dominating and doing really well in the energy drink space. Those are two companies that are easy for me personally to think through that they're going to do well. A third thing that I'm looking at right now is an ETF that I think is going to be rolling moving forward because inflation is going to be a factor. There's going to be more cuts to come. We are in the beginning. We're in like inning 2 of the cuts. Okay, so when we're looking at this, I'm even thinking an ETF like SPMO. Those 3 plays right there are pretty, like in my mind, as I'm thinking through where I want to go with everything, those plays are pretty safe and pretty standard that we can keep moving forward with. And then finally, what has done really well in the past when there's been, you know, a large amount of money printing, when there's been fourth quarter, that's when crypto rolls. Okay, and I'm thinking through this and I'm going, this is where BMNR might start to pop off. This is where Ethereum and Bitcoin really might start to pop off from now into January. So those are some of the plays that I've been thinking through for myself. Those are some of the plays I wanted to share. And I think it's really crucial to understand the bonds or the treasury market. It's really important to understand that when the Fed cuts, it doesn't have a direct impact on mortgage rates and things like that. It does make it easier for banks to lend money to those large corporations because different factors at play. But I think it's really important to recognize that these cuts might actually, we could see higher mortgage rates because of inflation. But hopefully we see some type of dent in the job market. The issue with that is that because of AI, because of the AI dominance, and we're seeing companies like Microsoft are already starting to cut because how they're using AI. We're seeing that. Even I have a buddy who works at UPS. They're already starting to get more involved with AI and robotics. Same thing with Amazon. So all of those other factors are really going to have a weird interplay with these future cuts. But I think the big factor is look at companies. Remember, it comes back to purchasing companies for what they are. You're buying a company if you're buying a stock. You're buying companies if you're getting an ETF. Okay, and that's where you have to think through. Like something like Celsius is an easy purchase for somebody at the grocery store. Same thing with e.l.f. It's cheap. Okay, the cheap makeup, it's cheap hair products. And even if you have money, well, now they just acquired Justin Bieber's Rhode, his wife Hailey Bieber's Rhode, what is it? Rhode makeup or whatever is the name. So that's where e.l.f. is going to have a positive impact. Possibly BMNR. I would look into that a little bit further, but you will see, I think, crypto start to pop off here in this quarter. So that was my thought coming off of these Fed rate cuts. I got a couple more days. I got 5 more days here on my business trip in Tokyo. I hope this helps somebody out there, and hopefully you can further understand what's going on. And I think we're going to see some more in October and probably in December as well. Peace.